Hello and welcome to Quantitative Investment Insights presented by Greenwich Quantitative Research. Greenwich Quantitative Research is a hedge fund based in Greenwich, Connecticut, focused on market-neutral quantitative investing in the Asia-Pacific region. I'm here with the company's founder and chief investment officer, Reilly. Gene has 30 years of experience trading and investing, including 19 years living and working in Asia. And in terms of career highlights, Gene was a partner at Goldman Sachs and run equity trading for them across the region. Gene also has substantial quantitative investing experience and more recently ran global quantitative trading for Merrill Lynch in New York. Gene, it's good to see you. Well, expanding on a theme we previously discussed, we provided a solid explanation for why China's onshore equity market is suitable for quantitative market neutral investing. We learned about many unique aspects of China's equity markets and explored the access channels open to foreign investors, namely QFE and Connect. Today, we're going to discuss the significance of the new QFE rules announced in 2020, and we'll review the various practical options investors have for executing orders onshore, and we'll cover important areas such as domestic exchanges and the broad range of share equity classes that is sometimes confusing for some investors. Now, before we get into the new QFE rules, let's talk about the success of the Connect program. Gene, starting with the 2014 Shanghai Hong Kong Stock Connect program, we saw a material increase in foreign flows into China, and this accelerated even further after the 2016 Shenzhen Hong Kong Stock Connect launch. So why did Connect attract so much more investor interest and flow than QFE and RQFE?
Oh, thanks, Leyla. Connect launched in November of 2014, well after QFE and RQFE. But by the end of Q1 2020, QFE and RQFE represented only a third of A share holdings by foreign investors, while Stock Connect investors represented 2/3. So really significant growth in that channel as the preferred channel for investors investing in onshore China. And the main reasons are investor access, ease of FX management, simplicity, and helping to fill product gaps, including the addition of China to the global index benchmarks.
Mm-hmm. Can you give us more background on these reasons? How was investor access different under Connect versus QFE and RQFE?
Well, Connect is a channel that's available to all investors and investor strategies for anyone who can open an account in Hong Kong. QFE and RQFE had strict qualification criteria, which meant most investors weren't actually eligible to use the program. The QFE and RQFE programs stated that long-term strategic investments were preferred. China's stance dissuaded eligible firms, who had short and medium-term trading strategies like hedge funds or even retail investors. So to satisfy the QFE and RQFE requirements, investors needed to fully invest their QFE. And it wasn't strictly enforced, but it created some regulatory friction, and also repatriation was an issue. So investors were holding, renminbi balances, even if they did not have, an investable stock position at the time.
You mentioned managing FX exposure.
Sure. Under QFE and RQFE, investors needed to be comfortable managing and hedging RMB. So RMB is a restricted currency. You had to hold a balance of RMB onshore. The only way to hedge that RMB exposure was using the NDF, or non-deliverable forward market, which, very technical for some investors. Under Connect, investors can execute orders and settle with either US dollars or offshore renminbi the same way they would transact with any other market. So it really created easier way to transact from an FX perspective, relative to the cumbersome FX requirements and potential FX hedging requirements, to transact via the old QFE and RQFE system.
Now, I can see why the FX management issues would be a major hurdle for most investors, and why solving FX management attracted more foreign flows. How is Connect simpler compared with QFE and RQFE?
It was simple and more flexible. Investors could use their existing brokerage accounts for Connect. QFE required QFE-specific accounts. The cross-border flow was handled by the Hong Kong Stock Exchange, So brokerage firms would only need to connect to the Hong Kong Stock Exchange that they already did business with. QFE investors had to establish their own onshore and offshore appointed custodians, as well as specific onshore brokers. So Connect just remains significantly similar in terms of obtaining the QFE license. The old program took 3 to 6 months to just get the license. The new QFE program has been simplified, but it is still a lot more time consuming and requires specific documentation and approval compared to Stock Connect, which is open to anyone who has an account in Hong Kong to trade equities.
What products or features did Connect offer that wasn't available in QFE or QFE?
Specifically from a regulatory change, the ability to utilize broker swap inventory to short became permissible under the Connect rules. That was specifically prohibited, under the QFE rules.
How did these changes impact the thinking of global index providers such as FTSE and MSCI on China markets?
MSCI specifically cited the market opening measures introduced through the Connect program as one of the major reasons they added China to the MSCI emerging market benchmark. And that provided a push for investors that were significantly underweight China to allocate into the market, and they had a much easier way to execute via Connect. So, significant inflow into the market, and gave investors, a benchmark that was much more representative of global market capitalization.
Mm-hmm. What about the recent changes to the QFE program? Given the great success of the Stock Connect program and the modest appetite, even among eligible investors for QFE and RQFE, why do you think China decided to make changes to the QFE and RQFE programs instead of concentrating its efforts on getting one program right?
It's not clear why China decided to close the gap between, the QFE program and the Connect program by revamping some of the QFE rules instead of just focusing on improving Connect. It's likely that in the long term, China anticipates that investors will be able to invest directly into China without going through an intermediary such as the Hong Kong Stock Exchange. At that point, potentially the renminbi would be, a freely convertible currency, and the difficulties in terms of international investors accessing the exchanges onshore in China might be eliminated. So from that perspective, they could see that evolution in the market.
I see. Can you discuss the changes made to QFE and RQFE and their relevance?
Sure. They've merged the QFE and RQFE programs, and they now collectively refer to them as QFE with one I. In January of 2019, the CSRC, SAFE, and the PBOC circulated a consultation paper on the proposed changes to the programs, and they requested market feedback. In September of 2020, they published the new regulations, which became effective on November 1st, 2020. And the changes included merging the two programs, QFE and RQFE, into QFE, are significant and represent another major market opening step by China. The changes address many of the issues investors faced with the old program.
Over the years, investors called for a number of changes to address QFE and RQFE program limitations and inflexible rules. We have already discussed the issues surrounding FX repatriation. Was FX management improved over the past few years by China's reforms?
Sure. In 2018, the Chinese regulators made capital repatriation more flexible by removing the lock-in period and permitting investors to repatriate their proceeds at any time. There previously had been strict limits on the amount foreign investors could take out of China at a time, and it took multiple years to potentially fully repatriate your QFE balance. And in 2020, they continued to address the process by allowing QFEs to repatriate proceeds shortly after they submit a tax commitment letter signed by the QFEs and their custodians. Previously, the process was time-consuming. QFEs had to submit a special audit report on investments issued by a Chinese certified public accountant, and tax clearance and tax certificates.
You mentioned QFE and RQFE are quota-based programs. There are quota limits at the individual investor level and an overall limit for the whole program. Did China address quotas in the 2020 QFE reforms?
Absolutely. In September of 2019, People's Bank of China and SAFE announced that QFE and RQFE investors would no longer need to have SAFE approve a quota for them. QFEs could simply request their custodian to make a registration with SAFE. The $300 billion overall cap on the program was also removed, and that quota removal became effective in June of 2020. So this was a pretty big change. Going back, more than a decade, there wasn't enough quota in the market for the international demand for Chinese securities. And as a result of that, there were sometimes, significant premiums, to access the Chinese market. And, as a result of that, sometimes the, Chinese ETF traded at significant premiums as well. So this should lead to a more level playing field, so to speak, in terms of international investors being able to access the Chinese market, in the quantities that they would like to do so.
Mm-hmm. How about investor access? Is QFE open to a wider range of investors?
Sure, they've relaxed that so significantly. There's no longer, previously there was a minimum period of which a firm needed to be operating before they would be eligible for a QFE. The applicants can now be all types of asset managers. There previously had been a strong preference for purely long-only investors to receive their own QFEs. That's now opened the door for, hedge funds to establish QFEs. Also, the language has been removed that gave preference to long-term holders. So that is no longer an explicit requirement. And the application procedure and the approval process has been cut down to 10 days from what was, potentially a multi-month process previously.
Mm-hmm. These changes sound pretty significant. Was the limited product scope addressed?
The investment scope's been expanded to equity investors. Margin trading and securities lending and stock exchanges has been approved. Stocks listed on the NEEQ are now approved for QFE investors. That's the third national equity trading venue after the Shenzhen and Shanghai stock exchanges. It's an over-the-counter system that was established back in 2012 for trading stocks that weren't listed on the two major exchanges. Also, options that are listed and traded on the futures exchange have been approved by the State Council or the CSRC.
Okay. Are there any other relevant changes to mention?
QFEs can now appoint an unlimited number of onshore securities brokers. Previously, that was restricted to 3 onshore brokers. Additionally, QFEs could appoint only 1 custodian. Now they can appoint 3. QFEs can invest using any currency and convert into renminbi via their offshore custodian. There's still a requirement that the funds must come from offshore. There has to be an FX conversion. They can't access it using onshore renminbi. The new rules have also enhanced regulatory oversight of QFEs, but at the same time, reduced the required daily data submissions.
A number of announced changes to QFE are still pending approvals and additional reforms necessary to make them viable. I have heard that while changes have been officially announced, many of the new features cannot be implemented at this time. Is that correct?
That's correct. Yeah, the wording of the new rules is sometimes vague, and the regulators need to provide detail on specific investment products. In addition, some of the activities permitted under the new rules can't be carried out unless other existing rules and processes are changed. Stock borrow and loan is an example. There are existing rules and processes that prevent that being transacted, even though technically it's permitted. China market participants have seen this before with other market opening measures. Sometimes it takes a long period of time, maybe even a few years, before all the newly permitted activities can be carried out. For example, stock borrowing and lending has been permitted under Stock Connect for a number of years already, but further changes are required before the activity can be actually transacted effectively. And there continues to be a dialogue with Chinese regulators as to how this can be more relevant to the international investor. If the announced changes to the QFE program are implemented as investors hope, yeah, it would solve all of these problems.
Since the new QFE rules came out, though, have any of the announced rules and features been clarified so that investors can actually benefit from the market opening measures?
Yes, to date, clarity has been provided on commodity futures, commodity options, and stock index options. In October, they announced that QFE investors will be eligible to trade commodity futures, commodity options, stock index options, and trade on futures venues that have been approved by the CSRC. Trading in stock index options will be limited to the sole purpose of hedging. So there will be, further rules clarifying what investors are going to be able to do on that front.
If we compare the QFE and Connect channels now, post the QFE rule changes, which program offers clients better access to China from an equity investor perspective?
The changes have been made to the QFE program over the past 3 years have now made QFE a better channel than Stock Connect for investors that have the infrastructure and staffing to manage the additional complexities of QFE compared with the simpler Stock Connect channel. For stock access, QFE investors can access all the stocks listed on the Shanghai Shenzhen exchanges, so 4,200 stocks, and on the NEEQ, which is over 10,000 stocks. Stock Connect has a smaller universe of securities of about 1,400. QFEs can now also access onshore ETFs, IPOs, whereas Connect cannot. Now, I would note that the QFE and Connect programs are not mutually exclusive, so investors that qualify can use both. If investors use swap, they can transact through their brokers who have access to both QFE and Connect, so they will have all the access available through both programs.
Connect has certainly been a very successful program in terms of opening up China's equity markets to foreign investors. The new QFE rules sound like they will provide even greater market access, but there are still market restrictions that impact investor access to China in a meaningful way. Currently, what are the remaining major areas that investors would like to see improved?
Yeah, as a result of these market reforms, MSCI, FTSE, and S&P added Chinese A shares to their benchmarks at an inclusion factor of 20 to 25%. And that means they are not fully representing their market capitalization weight in those indices. So there are additional measures that the index providers would like to see implemented, moving closer to international standards, and that would actually result in an increased inclusion factor. In terms of Connect, the introduction of block trading to increase liquidity in the market, is something that is sought. Harmonization of the Hong Kong and China trading calendars to avoid days when the Chinese A-share market is open, but Stock Connect investors can't trade because the Hong Kong Stock Exchange is closed, and an increase in the eligible securities. So, there's really no reason why the Connect channel couldn't have all the securities available that the QFE channel currently has. So for both, QFE and Stock Connect, order cancellation in the flexibility to cancel orders in the open and closing auction, aligning the settlement cycle, the short settlement cycle onshore creates challenges for global investors. It doesn't support settlement on trade date of shares purchased on trade date. Leveraging the Stock Connect platform can resolve that issue. Also, for stock borrowing and lending, programs have been officially announced for both Stock Connect and QFE, but neither program can be yet used at this time because there needs to be additional rules and clarification as to how exactly it's going to work. Brokers have been able to offer, de facto stock loan access via swap for the Connect channel, and will now likely be able to offer exposure for QFE since China has approved shorting for QFE. Additionally, there's a 30% foreign ownership limit. Foreign investors in Chinese companies are still subject to that cap. At certain times in the market, that cap has become problematic in certain securities where, the international community is at the cap and essentially getting access to the stock can be essentially, rationed or, essentially distorted in terms of a premium.
Well, now let's look at an actual order execution. What are the various execution options available for investors via the QFE and Connect channels?
First, it's important to stress the same rules that govern the domestic investors in China are applied to foreign investors. So whilst it's a different market microstructure with its own compliance rules, Generally, those rules are the same for onshore investors as opposed to offshore investors utilizing the Connect channel. In terms of what the relevant rules are, the CSRC's China equity markets regulated by, by the CSRC. There's also the Securities and Futures Commission in Hong Kong. Other relevant regulators for QFE are the CSRC, the PBOC, and SAFE.
Okay, now let's hear about the different ways to execute orders in China to see how similar it is versus developed markets.
Sure. In terms of QFE, it's, cash stocks can be executed directly through the onshore broker and custodian. Swaps can be executed, using the broker's QFE. Securities can't be purchased and sold on the same day, and that's true for all investors in the market. So if you buy a stock, you have to wait, 24 hours, you have to wait until the next calendar trading day to sell the stock, which has, reduced the frequency of turnover in the market. Stock borrowing and lending are now permitted under the new 2020 QFE rules, but they haven't clarified the details yet. There's some conflict around existing rules. Consequently, shorting via QFE is not practical at this moment, and using brokers' long positions to sell long on swap is the only way at present to gain short exposure to the market. Over time, China will work with market participants to change the rules, processes, and infrastructure to support a more robust stock loan and stock shorting capability, for QFEs. For Connect execution, it's very similar to QFE because the onshore rules apply. You can purchase both cash stocks as well as swaps. The same rules apply about being able to purchase and sell a stock on the same day. Securities must be purchased the day prior to being sold. Investors can short on swap by using, long inventory that their brokers may have, but that inventory must have been purchased prior to the trade date.
Mm-hmm. All right, let's move on to exchanges. Can you give us an overview on the different stock exchanges in China? Shanghai and Shenzhen are the two exchanges most investors are familiar with.
Sure, absolutely, and they're some of the biggest in the world now. The Shanghai Stock Exchange actually opened in 1990, and it operates, two main boards. One is the main board where they have large, middle, and small cap listings, and then there is the Star Market, which is a science and technology innovation segment of the market, and that launched in 2019, focused on tech stocks. Then the Shenzhen Stock Exchange also launched in 1990. The Shenzhen Exchange has three major components. One is the main board, which has large cap listings. Then there is the SME, small and medium cap, venue, and they also have a program called ChiNext, which focuses on high growth and technology oriented startups, similar to NASDAQ does in the United States. And that was launched in 2009. Okay.
And I heard that China just launched a new stock exchange in Beijing over November 15th. Can you tell us about the Beijing stock exchange? And also, when you discussed the new QFE rules, you had mentioned the National Equities Exchange and quotations.
The National Equity Exchange and Quotation, NEQ, established in 2012, is an over-the-counter system established in Beijing for trading stocks that aren't listed on the major exchanges, similar to how pink sheets work in the United States. It's approved for QFE investors via the new rules, but not yet for Connect investors. The Beijing Stock Exchange just launched, this year, November 15th. The Beijing Stock Exchange, has strong government sponsorship. The purpose of the Beijing Stock Exchange is that it will complement the Shenzhen and Shanghai exchanges by focusing on small and mid-sized companies and provide an additional source of capital. Small businesses have had difficulty getting funding from banks, and it's designed to be an equity funding option for those smaller businesses. Policymakers would like to promote innovation and technology entrepreneurship domestically to grow China's tech sectors specifically. The rules allow it to process listings more quickly than other exchanges. The first round of companies that are being listed are mainly software, pharmaceutical, and high-tech manufacturing. And there's about 81 stocks listed, 10 were IPOs, and 71 were quote unquote promoted from the NEEQ. So it's really interesting to see, how so many dynamic changes are taking place, and that the market is becoming, significantly more similar to the options that investors have, on many of the international stock exchanges.
Yeah, absolutely. Well, this has been so informative. Thank you so much, Gene. That's all the time we have for now. I'd like to thank you, our listeners, and I would look forward to covering more topics in the future. We'll see you next time.